I mean, when you talk to any sort of lending institution today, nobody realizes that Bitcoin is just like nobody loses on a Bitcoin loan. Why? Because you can control the collateral. So like, what other all the think about all the most prominent forms of like bank lending that you have today, and you can't control the collateral the way that you can with Bitcoin. So if you can literally just hold it in escrow, and the person who has it only wants to hold it, um, then that's a pretty good business model.
Bitcoin is a currency on the internet.
If you don't trust any other currency, this is where you go.
It's going to outperform everything.
Bitcoin could eventually be worthless.
Every day is a good day to buy Bitcoin.
Bitcoin reached its highest price to date.
Bitcoin hitting a new high. It really has reached escape velocity.
There is no second best.
Who cares about Bitcoin?
It's the only secure database that's ever been invented.
Antisocial.
Bitcoin is the real deal.
Stupid.
Everything is bullish for Bitcoin.
Immoral.
It's going up forever, Laura.
Fix the money, fix the world.
Wyatt is a registered investment advisor, and the opinions expressed on the show are their own and do not reflect the opinions of the Silic LLC. Joining this as a CPA, and the opinions expressed on the show are their own and do not reflect the opinions of Trusted CPA or other affiliated firms. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendation appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Any statements or opinions are subject to change without notice.
Hey, welcome back to the Bitcoin for Financial Services Media Podcast, the podcast where sound money meets professional services. We explore how to build a financial system within the principles, values, and ethos of Bitcoin. And today we're joined by Eric Yakes, managing partner at Epoch Ventures. All right, let's get started.
Welcome back to Bitcoin for Financial Services Media. Joined by a special guest here today, a man who needs no introduction, Eric Yakes. Thanks for coming on the pod, man.
Wyatt, I'm excited, big dog.
It's great to have you, man. Where are you calling in from?
The space, Denver. Huh? We are the premier Bitcoin Citadel. Where are you calling in from?
I'm also at the space. I don't know if you know this, but Jordan's a park member.
Wow. Okay.
Wow.
Oh,
wow,
God.
we're gonna go there. I'm actually also at the space. I feel like Wyatt is like right above Eric, like physically. Is that right?
Ooh, that's interesting. I never really thought of it. No, because I'm on the other side, so no. Wyatt's like right up here. We're not that far though. We're probably about a quick little crow's flight right upstairs.
It's true, and I mean, this is really inside baseball. Most people don't know the space has a class system. It's the upstairs folks and the downstairs folks.
Right.
Really only Eric and the Epoch team that are downstairs folks.
Epoch team is plebeian, and Wyatt's a part of the aristocracy. But we have had revolutions before, and the aristocracy is very afraid.
Eric or Wyatt, can you just look down on him right now, physically? He's down there, right?
Yeah.
Okay, he's down that way. Wow. Yeah, I feel like I'm picturing like that you guys are like the hands, touching God kind of thing.
Right.
So reaching for each other. Okay, Eric. So Wyatt knows you better than I do. We've met. We've had wine together, I think, in the last 2 or 3 weeks, which, by the way, that cab sav, I'm still thinking about that cab sav from Ben Justman.
It was great. I'm a big fan. Yeah.
So tell us about how you got into Bitcoin, and then what do you do in Bitcoin today?
Yeah. I was just always I always loved economics. That is just always something that was kind of like an interest, passion of mine. I chose to study finance and economics in college. Finance just because it's a good, it's kind of like the optimal tool set, I think, for what I wanted to do with my career. Accounting's kind of like the language. Finance gives you a little bit of that language. And then finance teaches you, how to use it a bit. That kind of drove my passion for a lot of the things that I was doing. I always had this plan that I wanted to work for a private equity fund when I was an undergrad, and I, eventually got to that point. And, I think when I was there at the time, it was something where I spent all this time doing this job, and I was obsessed with Bitcoin. And Bitcoin captivated me because of my love for economics. I was, acutely aware of a lot of the issues that exist within central banking, and I was just very nihilistic about it at the time. And it wasn't until I discovered Bitcoin where I was like, oh, here's like an actual option other than just the cycle of boom and bust history of central banking. And that got me really obsessed. And then I decided back in 2020, just a little bit before the pandemic, to quit my job and jump all into this industry. And I wrote one of the early kind of like economics books on Bitcoin. When I got involved, there was really only the Bitcoin Standard was kind of the main book everybody was familiar with. It was that or technical books on how Bitcoin works, like Mastering Bitcoin. And the Bitcoin Standard is a great book, but it wasn't something that I would go give to a partner at the former firm I worked at. It was a bit theoretical. I think people needed a more practical, historical representation of, what the value proposition here is of Bitcoin. It's a bit less biased, a bit more measured around, even if you hate our ideology, this thing's going to happen one way or another. And I wanted to make that case through my book, and that's kind of what got me started in the industry. And then I spent a bunch of time thinking about what, Bitcoin needed. And I think early on, I'd always wanted to start a venture fund, but it was a bit early at that time. And I think particularly, this was right around 2021. 2021 was that year of all the venture capital raised globally. Crypto was the largest percentage of that historically. It was billions of dollars. It was over 30% of global venture capital that was raised. Like, it was a crazy anomaly. And there's a bunch of reasons we can go into as to why that happened. But back then, trying to compete against that narrative wasn't something that I thought made a lot of sense in capital allocation. I thought that was something where, like, the Bitcoiner narrative was going to be drowned out until eventually, we're proven right in hindsight. And but it wasn't until around 2023 that I was like, okay, this is starting to change. After the prior crash, after I could see that, like, institutional people, their thoughts were changing. And in a lot of these narratives like created by Chris Dixon on read, write, own, and all of these Web3 ideas, those were dying off. It was becoming drastically apparent that the maximum value proposition you can probably get out of a token is airline miles equivalent or some sort of loyalty programs, and those typically only work under oligopolistic markets. And then it's like, okay, so maybe this isn't some major innovation. Maybe this is something we've always had on a new rail. And that's what a lot of, settlement on blockchain technology is like, we're going to have securities too. And that's just a new rail for the same concept. It's not a new concept. It was around then that there was that, and there was the development within the ecosystem, and there was also me just learning more about the size of the market within Bitcoin that made me think, okay, now's the right time to be doing something like this. So by 2024, we had launched our Fund 1, and we've just been deploying our Fund 1, and really we're investing in the Bitcoin ecosystem. And what that means in a more pointed way is that we're investing in, like, fintech. We're investing in the things that people need to use Bitcoin in all the different ways that you can use Bitcoin, whether that's custodying Bitcoin, conducting payments in Bitcoin, getting loans in Bitcoin, all these different types of business models, whether it's software, whether it's hardware. There's hardware devices, there's new types of mining manufacturers, all these different types of companies that are all part of the ecosystem, allowing it to grow. And our bet is that Bitcoin's been the most rapidly growing asset in history. It's going to continue to grow rapidly, and that's the alpha that nobody's aware of. And the infrastructure around it is somewhat of a levered private market play on that growth. So we're targeting companies that have unit economics that are tied to the growth in the capital appreciation of Bitcoin. And yeah, so that's kind of that's the bet that we're making. And we got our team together. We started moving on that, and we have currently today 14 portfolio companies. Wow. And yeah, life's pretty good.
This episode is brought to you by Satoshi Pacioli, a full-service accounting and tax firm built for the Bitcoin economy. If you run a Bitcoin business, mine Bitcoin, or invest in it, you need advisors who actually understand how this industry works. Satoshi Pacioli handles bookkeeping, financial reporting, tax compliance, and strategic planning for Bitcoin-focused companies and individuals. They speak the language of Bitcoiners and help you stay compliant while building for the long term. To learn more or book a consultation, visit satoshipacioli.com.
Very nice. Okay.
Do you think like a cost basis tracker for Bitcoin is investable?
A cost basis tracker for Bitcoin.
Mm-hmm.
Hit me.
That's such a poor way to describe it, Wyatt. I'm not going to pitch. I'm not going to. It's an interesting time, right? Because, and I do want to get your thoughts on this, right? Of like, okay, so I have a startup. We raised a little bit of money. We haven't gone VC yet, but in this world where you can build faster with way less capital, that's one argument. But then the other argument, you don't raise capital, and the guys who did raise capital with VCs, they basically beat you to the market share, or they steal your existing market share because they have more capital behind you, even though you maybe got to market first because you're just a little bit leaner. I'm curious your thoughts there, right? Because there are a lot of like, oh, I can go at this with a lot less capital than I used to have to do maybe 2 years ago because I just need less engineers, right?
Yeah.
On the software side specifically. But is there a mistake in thinking there where like maybe that makes sense for, you know, a little bit, but then you get absolutely murdered 12 months and you lose your friends and family's money because someone else thought longer term and they raised capital and put that behind the product?
Yeah. There's, there's a graveyard of hopes and dreams behind a lot of startups for a lot of different reasons. And but to answer it like directly, like most businesses, I would argue, don't want to raise venture capital. Most businesses are based on more localized markets with lower rates of growth, and they're like lifestyle type businesses. These are things I would say the vast majority of small business in America and volumes are kind of based around that. And there's not a bunch of venture capitalists running around doing that. There are a bunch of private equity firms that try to do different strategies with small businesses like that. But venture capital is kind of a different model where, we go to our investors and we talk about our thesis like what I just described, and there's certain expectations of returns. And if we do not meet those expectations of returns, then we aren't going to last very long as a venture capital firm. When you have a certain business that wants to raise venture capital, oftentimes there needs to be a match. There needs to be an equilibrium point found between the return potential of the investment at the valuation the venture capitalist is getting and the expectations of the founder of the future. And if you can find that equilibrium, then often a deal will happen where you can get some investment. But there's with most startups, the return potential for what you would have to give up to make the return potential attractive is not going to find equilibrium. It's out of market, right? Like you're just like, okay, well, why would I sell this much of my business? Because then by the time we actually get there, I will have sold so much of my business that it doesn't really make sense for me to even do that in the first place. Maybe there's another way. And that's what a lot of people spend time doing. The only way that you can really change that is to change the capital provider's expectations of what you're doing. And that's not an easy thing to do, usually because it's based around the history of a person. But I think that to answer the question, when you have a venture capitalist writing you a check, the primary question is like, how much ownership can we get within this company for the amount of risk that we're taking on? The vast majority of investments being made are going to fail for reasons like you stated. You can have competitors step into a market very quickly. And those guys might have gotten diluted very significantly by venture capital coming in. Whether, maybe they only have 15% left and you have 40%, but their 15% is actually worth something because they took on the money. And those are the bets that everybody has to make. We as a firm, we're helpful, we're honest, we're patient. I think one of the mistakes that you can make is providing venture capital is not being honest with the people that you're dealing with and trying to be nice or whatever. If I think people have stupid ideas, I tell them they have stupid ideas. And it's like, go prove me wrong, but I'll tell you what I've seen and what I think would be helpful to you. And it's not even really about the idea typically as much as it's about the situation that a person's in. Most ideas for startups are going to change very significantly if they become successful. If this company becomes successful, it's going to have multiple pivots. It's going to, and those are from
That's so true.
Yeah, it's not about the idea really. I got a million great ideas. Like it's not about that, and my ideas are probably better than most people's. But the only thing is who is the founder and what are their capabilities? How resourceful are they? What situation are they in life? What experience do they have? There's a bunch of different variables that come into like, is this guy a dog who can dedicate his entire life to pivoting a company over and over again until it's successful? Or is he kind of like, oh no, I'd rather build like a lifestyle business or something and let it grow more gradually. And that's kind of the difference. So like when you're trying to do that, you're out of market for venture capital. That is like a friends and family thing. But then sometimes it's easier to make a bet on something that isn't going to be a fat zero. Like you could pretty much guarantee that if you want to go start like an IT services business in your local market, that you can make money doing that. If you can pretty much guarantee if you start a coffee shop or a restaurant, and these have high turnovers and failure rates, but you are going to make money. It is going to have some sort of value. All of these like localized type businesses that are more lifestyle people can do. It's just as you get into bigger, less certain, more futuristic markets, the greater that degree of uncertainty becomes. And then your potential of taking a riskier bet on, will this market emerge in the future? Am I building a product for a market that doesn't exist today, but I think will? That's where you're taking on more risk. And that's where when you see, Mag 7 type companies, and their origins were often from founders who built a company before the market existed, created the market, and then had monopolistic share of the market and grew absolutely rapidly because of it. So it's a lot more risk that you're taking on, and that's what venture capitalists are typically targeting. And that's where you have to get a venture capitalist to find a belief in your idea. You're often selling a vision when you're trying to do that because you can't point to numbers or anything. So you have to sell the vision, and then you have to make the case, even if you sell the vision, for why you over anybody else is the best person in the world to be starting this, and you're not going to ever get out competed, and the only thing you're missing is money. If you can get money, that solves everything else.
Yeah, that's great insight, Eric. Appreciate that. I'm just curious, so you're in a unique position where you see a lot of different companies, you see a lot of different opportunities, in the space. What are maybe kind of some parts of the financial services ecosystem you think are well served by startups or companies in the space? What are some of those opportunities? And then maybe if you could kind of parlay that into how your portfolio is interacting in the financial services industry.
Yeah, it's interesting. I'd say some of like the more like basic infrastructure at this point is a pretty well trodden path and it's well served. More by generalist companies though, like crypto type companies so Bitcoin custody solutions is an example. It's just like a form of infrastructure that underpins so many other different financial functions that you need. And that's something that's been around a long time, pretty well served by a variety of different companies in a bunch of different formats. But it's more of a function than it is a business. Like custody itself is not a good business, but it is a good ancillary service to be provided on top of other much more profitable services. So something else that's reasonably well served within the non-bank market today is lending, and that is a very profitable business. And I think that that is ripe for growth. And to the point I was making earlier of like, what kind of businesses are we targeting? Well, we want businesses that grow as Bitcoin grows, and the lending market's a perfect example of that. The AUM of the client base grows with Bitcoin, and there's somewhat of a degree of countercyclicality to it too, which is nice. Like when Bitcoin crashes, you actually make a lot of money on liquidations, and so the lending market's a really cool market, but I expect it to grow a lot more. I think if you look at the percentage of leverage in the system in the 2021 cycle to like broader crypto or even just Bitcoin specifically, and you look at where it's at today, there's just not nearly as much leverage in the system as there had once been. And I expect that not only that will revert, but I expect it'll get much larger. I mean, when you talk to any sort of lending institution today, nobody realizes that Bitcoin is just like, nobody loses on a Bitcoin loan. Why? Because you can control the collateral. So like, think about all the most prominent forms of like bank lending that you have today, and you can't control the collateral the way that you can with Bitcoin. So if you can literally just hold it in escrow, and the person who has it only wants to hold it, then that's a pretty good business model. So that's something we're pretty excited about. I think the other thing would be like cross-border payments is another emerging area that's like, it's reasonably well served. I think there's a decent amount of companies doing it today, but there's a ton of problems that need to be solved within it because it's one of those markets where there's a lot of legwork that needs to go into building everything. It's kind of like, it's like the telecommunications business. It's like, well, we got to go drill a bunch of landlines. We got to put a bunch of shit underground. It's kind of how it works with cross-border payments today, is that until everybody switches over to digital rails, if you want to have a cross-border payment business, then you need to get bank relationships all over the world. And I think there's a lot of neobanks that are starting to participate in this, and they realize that. They're like, okay, if we want to provide a good consumer experience, and I need to have on-ramps and off-ramps everywhere I can. And that's kind of what the value of Bridge was when Stripe acquired them for over $1 billion. They just had a really good footprint of banking relationships. And I think that's true today. I think that for Bitcoin, it's going to go through this transitionary period. Like we're kind of we're in the adolescent phase where it's like, your hands and your feet grow first, but your body's still small and like you look goofy. And like Bitcoin's kind of in that with, there's certain aspects of it that are outpacing other aspects of it. And I think we're going to be sitting in this like bridge between the traditional finance world and the digitally native Bitcoin world for a while, in businesses that are kind of playing in that realm where you're acting as basically like scaffolding in between those two worlds. Those are businesses that will attract a lot of profit because those are businesses that are going to where customers are at today and meeting people where they're at today. That's one of the challenges with like true Bitcoin native businesses is that nobody's on these rails. The largest forms of capital and customers aren't there yet. You transition them over by meeting them where they're at. And then eventually, like, why am I using this shitty old banking app and whatnot? And why don't I use this newer form? So you can wait until Gen Alpha and Gen Z are all worth as much as the millennials and Gen X are today, or you can build a business right now that meets millennials, Gen X, and boomers where they're at.
Yeah, I mean, okay, so yesterday was tax day, right? And so it's so sad, right, to watch. Yesterday, our big goal was like, okay, if you owe tax, we've got to get checks in the mail, payments made. And it really is sad to see someone write a check for $100K, $300K to the government because they had to liquidate Bitcoin to operate their business or whatever it is, right? And they have low cost basis Bitcoin that they bought a long time ago. And that's why I'm super bullish on the loans, the repos, because it's much more favorable to get access to that capital at a 5% or if it's a repo, or even at a 12, 13% if it's a loan, instead of having to pay 37% plus your state rate if that applies to you, which hopefully it doesn't. And so I'm very, very bullish on that because there's a lot of pent up capital that we see even on our own clients' balance sheets, personal or business, that they could go do a lot of things with, but it's like, well, how do I get access to it? I could sell it, but if I sell it now, I've got this huge liability that I've got to pay.
Totally.
So
And
it de-risks it all.
Exactly. Yeah, there's this perennial bid on Bitcoin for loans because people want to hold it. They don't want to sell it. And the time horizon, uniquely, I think, to Bitcoin is, exceptionally long compared to most investments. And that's a perfect environment for and what you guys deal with all the time with any sort of, traditional wealth diversification of people that have like a concentrated single asset position and, maintaining a leveraged position to diversify that exposure out of it. It's kind of akin to that, but for something that is, potentially going to be held for a lot longer and where the collateral can be held very directly.
Your wealth deserves intention. Basilic Financial is a Bitcoin-focused wealth management firm built to help our clients find balance between money and meaning. We integrate sound money strategies across 4 distinct personalized services: financial planning, individual wealth management, retirement services for SMBs, and Bitcoin financial services. Your prosperity, your purpose, intentionally guided at Basilic Financial. Visit our website at basilic.io to schedule a free consultation.
And something you kind of touched on, Eric, I'm just curious your take. So when I was at Bitcoin Amsterdam, Jack Mallers to sit down with your buddy Peter McCormack, and he said there were 4 profitable business models in like crypto broadly. It was lending, exchanges, Bitcoin treasury companies, and stablecoins. What's just kind of your take on that?
Yeah, those are profitable. I don't know why people overlook mining so much. Bitcoin mining's companies have made so much money. Bitcoin mining hardware companies are massive unicorns. I mean, like, what happened with Bitmain, putting politics aside, etc., like, what these guys did in, like, semiconductors is novel. I mean, the semiconductor industry in terms of design has been dominated by, an oligopoly for forever. And then we had these mining companies pop up out of nowhere and create these ASIC machines and become a monopoly for over a decade, multi-billion-dollar unicorns, and it really hasn't had any sort of competition step in until Block had to step in and start, kind of designing things themselves. So like, there's a lot. I think people overlook a lot, but like, yeah, generally speaking, those are the big ones for sure. But hardware's huge, mining's huge. Mining, I think, is changing a lot right now. And I think it'll continue to change. And I'm curious to see what new markets emerge from being forced through AI competition into more stranded sources. But I could see some valuable businesses emerging from that type of a shift.
Like, what are your thoughts on like the whole Larry Fink tokenization of financial assets? Like, I work out of a traditional financial advisor office, right? So I hear them talking, and I went and talked to one of the partners the other day, and I was just talking to him like, you guys, you make your money on AUM, and that's one model. But what happens when there's fintech products now where you don't have to rely on, a fiduciary to hold all the stocks that your clients own, but they don't hold the actual asset? What happens when that is able to be held in a 2 of 3 type of setup? Like, I guess the certificates to the stocks or the bonds. I'm just curious, and I love that you mentioned the fintech, because I see all of that world. That's just a fintech play that comes in and disrupts a very mature Fidelity, like all of these asset holders, or what do you call them, like asset managers, I guess. Sorry, I'm not in that world exactly, right? But I'm just curious on your take on, everyone's talking about this like tokenization of everything. Are you seeing that fit into a Bitcoin narrative, or is that more just some kind of other narrative? And are you investing in anything like that?
How do we think about tokenization, and how is it good or bad for Bitcoin? And tokenization is just getting everybody on the same rails, right? Like, we have this old system that is in I think a better way of thinking about this is with any sort of system that we develop as people, right? Like, there's always an issue of things being fractured. So you can take language, for example. Language is a hard thing for us to get consensus on. You have some things that generally emerge over time, but there's always fractures of people using different languages in different pockets, and they persist for long periods of time. And the traditional finance system in terms of Rails is kind of like that. And then over time, we did have, with dollar dominance, some systems become very dominant systems. So we have these old systems with old standards, but even within those, there's a bunch of issues, like all the issues with cross-border payments we were talking about before. Wire payments are slow internationally and incredibly expensive, and sometimes don't even work because there's a bunch of people on a bunch of different systems all over the world that a payment has to hop through all these different banks before it gets to a final destination. There's different data formats. It might have to go through a bank that still is literally using manual entries for things. Like that happens. And so that's kind of one of the problems with the old system is it's a patchwork. It's just like this fragmented patchwork type of a system, and it has a bunch of inefficiencies because of it. What's really cool about what emerged with Bitcoin is that it introduced the idea of taking a cryptographic digital signature and using that as a representation of value. And now that we have that, we can take this one type of standard that works for everything, and it's growing very rapidly. And people are like, well, it's so much simpler and we can get everybody on this. And it's, you don't have to like maintain your own home database. And we have novel ways so that the actual consumer can own the asset themselves, because that's what it was designed for originally. So we just created a lot of efficiency in terms of like representing an account digitally. And that's what we're doing is we're moving people over to that new form of representation. So whether it's like a stable coin, or whether it's a tokenized asset of gold or whatever it is, the more people that are using a digital signature for something, the better it is for Bitcoin, in my view. Because the more applications, the more companies, the more people, that have digital signatures becoming the global standard for what a payment is and what asset ownership is, the easier the move from I own dollars to I own Bitcoin can just become a flip of a switch. Whereas moving dollars from bank account into Bitcoin has a lot more steps involved, a lot more friction, a lot more cost, a lot more regulatory risk. There's all these different things that could cause problems between moving your money out of a bank into Bitcoin. Whereas if you own your money in something that can easily, like a digital signature, you can easily switch it to Bitcoin. So I view that all as just kind of to my point earlier. It's kind of like we're scaffolding this old system, and we're creating scaffolding so that it's a lot easier to bridge people into the newer system.
Do you see a risk though where, like, because you said everyone's got to be on the same rails, do we run into a very similar issue if there's, some stocks are tokenized on the Ethereum rails, some stocks are tokenized on, Bitcoin over Lightning, where you still, in order to make the switch, you kind of still have to go to an exchange or some kind of like, I guess, Uniswap or some company like that, right? That has rates to exchange. Are we still kind of in the same world there? Maybe a little bit faster and cheaper, but still having to ask for permission versus everything being on a Bitcoin rail or a layer 2 on top of that?
Right. So whether it's Ethereum, whether it's Coinbase, whether it's a Bitcoin rail, a Bitcoin layer 2, whether it's like any of these options, it's just we are talking about different signature standards and their compatibility with one another. What I will say is that it's a lot better than how the world works today, but nonetheless, there's a lot of challenges with it. I don't think that this. I think like one of the harsh realities that I think a lot of that people are going to eventually come to over time with this is that like open source software, bottom up movements, all of these things are amazing. They bring us valuable resources, things, and they're a very important deterrent, I think, against the alternatives, and that's good. Now, the challenge is, I think a good example of this would be the Lightning Network. When you introduce something that needs to provide a certain level of consumer experience and you do it in a bottom-up, more decentralized way, what did you get? You got a bunch of competing standards with Lightning. There's a lot of details within it that people haven't settled on to this day, and that impacts things. If you've ever had a Lightning wallet that isn't settling with another Lightning wallet, it's because of some of these issues. And I think that when the reason that like companies go through a startup period and they build something and they test it before they go out to the mass market is precisely because of that problem. They don't want to expand and scale until they know that they kind of have their ducks in a row. And I think that that'll be one of the challenges, is that as it relates to tokenization in the future, who's going to have the greatest competitive advantage with creating the most dominant standards? Be something that is the most open. I think that's the winning formula for Bitcoin, the base protocol, and it might work for another layer or two. But if we look at like the internet, there's a few open standards that we agreed on in the beginning, but then the way that people interface with it, the way people interact with it, wasn't based on people, dealing with some sort of open standard. It was based on people dealing with a company, and a company that provided them what they need. And I think that we'll probably be running into that with tokenization, where people are saying, okay, people want to get a product, and whatever companies have the most capital and the ability to scale that product and get it in front of consumers most quickly with the deepest liquidity, et cetera, they're going to become very dominant standards within this. Now, if you can find a way to use an open protocol to implement some of these things, that's great. But I think one of the harsh realities is that a lot of companies are probably going to dominate some of this. And it might be some time until, it's like a universe of open protocols that everybody's dealing with and swapping between.
Yeah, that is really interesting insight, and it's an exceptional transition, Jordan, so I took the cap for you. I'm not going to ask you about tokenization because I'm not a shitcoiner, but I do want to ask you about stablecoins, and two questions. And you're a prolific writer, and you've written about free banking. I want to ask you about your annual report. So prolific writer, mediocre tweeter, but prolific writer. And so I'm like vaguely keeping an eye on stablecoins. It seems to be all the rage, and I'm wondering if you feel like stablecoins are free banking 2.0, which is question one. And then in your annual report, which if you haven't checked out, I encourage people to go look. They're extremely detailed. You guys cover a tremendous amount of information in them, but you were talking about consumer-facing businesses, operating within the Bitcoin space, adding stablecoins to like their offering suite. Do you feel like stablecoins are needed to accelerate Bitcoin adoption or growth?
So, to the point I think I was making earlier of meeting people where they're at, building bridges and scaffolding from the old system into the new, I think that's what stablecoins are doing for people. Stablecoin, I don't think like anything's really needed for Bitcoin growth other than the internet. But what will make it occur more rapidly versus other alternatives? And I think that the pace at which it grows is important. And when you think about a stablecoin, it's important to really understand what's happening. So if you understand what's happening with the banking system, we can contrast why stablecoins are having this historic level of adoption. And in the way the banking system works today, you have what's backing every dollar is effectively the creation of dollar-denominated debt by the U.S. Treasury. And when we issue a Treasury bond, we have some proportion of that's effectively demanded by the market. Some people want this crappy low interest rate that's below the level of inflation, and then some people don't. And there has been this increasing gap in the market between the amount of debt issued by the government and the amount of people that actually want to buy it at this point. And we have a central bank that kind of makes up that difference by telling all of the major banks and saying, if you guys buy this debt, then we'll buy it from you. So they're indirectly kind of influencing the demand for the U.S. Treasury debt. And then that creates reserves within the system whenever they buy it, which those reserves can then be referenced by Federal Reserve member banks and used as inside money to make loans. And then that money is then made loans again once it goes into another bank, and so on and so forth, and you have this money multiplier effect. So there's a bunch of really dumb steps involved in the creation of money that don't seem to really make any sense. And it's kind of because we forced what was traditionally a private system in, and we tried to shove government debt into the mix is what should be backing all of it over time. And we did it successfully, or the government did it successfully. And so we have this system with like a million steps between debt gets issued, backs your money, money gets into the end person's hand. Now let's contrast stablecoins with that. Stablecoins say debt gets issued, we buy it, it's in the consumer's hand. So just cut out all these intermediaries in between that are involved in the money creation process. And that's a really important point because it's disintermediating the financial system. Now, what does that mean? Like, why are people afraid, or banks afraid, or all the implications about it? People are like, okay, well, stable coins are becoming like money market funds, and they're starting to pay a rate of interest. And that's what has people scared, because nobody makes interest on their bank account. So if you can own a stable coin and that's effectively acting like a bank deposit for you, then you're going to pull your money out of the bank and buy a bunch of stable coins and get a much higher rate of interest on it. So when we had the Genius Act pass in the U.S., the regulatory lobbying and regulatory capture effectively by banks, and there's this letter that was written during the Genius Act by the Community Bank Association. They're just like, look, like, if you guys allow stablecoins to pay interest, like, we're going to go under. It really doesn't make sense for anybody to use a bank. And it's like, oh my God, no way. Like, yeah, totally. Like, that's exactly the point.
We hadn't thought about that.
Yeah. And it's really funny because everybody's like, oh, it could be a systemic risk to the financial system. And it can, because we don't have a financial system that's built to serve consumers. And that's what these mechanisms are built for. So it's in direct competition with that. And when we are paying interest out to the tune of 4 to 5% or whatever the rate of treasury bills are through a stablecoin, then eventually it's going to cause that system to, crumble over time. So the Genius Act specifically said you have to hold government denominated liabilities as your reserves. You can't hold anything else as your reserve in a stablecoin if you want to do it in the U.S. And you can't pay interest unless you have a banking license. So the banks get to keep being shitty, and then stablecoins have to go do their business elsewhere effectively, or create a much less competitive product within the U.S. So I think like the big vision here is to answer your question of like how that ties back to Bitcoin adoption. So the first thing I'll say is that we've had this debate before. Money market funds, when they emerged in the 90s, this debate was being had about, are they going to be competitive with bank deposits? And the answer was really no. And money market funds are very large today, and your account can give you exposure to money market funds through most banking models. And the difference is that money market funds couldn't be used for a form of payment. And it's just like, this is like, I think, an aha moment for a lot of people, is like, wow, so we have all these, why don't we just trade treasury security debt directly? Like, why do we have to create all these steps of calling it currency? Why don't we just trade the interest paying thing and we all hold it? I think the answer is that you do need one layer of separation because money needs to be fungible. And treasury debt isn't fungible. You have different maturities, different issuance, different interest rates. So aggregating it, a variety of debt across, and then creating a fixed form of liability that you are affording to the end user, that is a way of kind of blending the treasury debt together so that it is a fungible asset for people to use for payments. And that's kind of what a stablecoin is doing. So, but yeah, it's like, okay, so now we're going to be using it for payments and trading the interest bearing thing. So what does that do? It gets everybody using digital signatures and on these types of rails. And at a global level, not in the US, but at a global level, like Tether has like 5% of its reserves in Bitcoin. So that's pretty cool because it's not just government debt. Now, that is the big aha moment. I think people are kind of thinking about it with stablecoins right now. But this is the case for Bitcoin. This is why focusing on just using stablecoins and the adoption of stablecoins is a completely myopic perspective. Why does Tether have some amount of Bitcoin in reserves? And when we think about this from the perspective of, okay, if we're using treasury debt to back something and we get a certain rate of interest on it, and that makes people want to own it. They want to own it because they're going to be earning a yield when they own it. What happens in a world where we have a bunch of stablecoins that are all competing based on yield? Then it becomes a game of, well, who's going to try to outpace the other guy? And how are they going to do that in a sustainable way? And then that's kind of when we get into like a free banking type world, to the point you're bringing up, Wyatt. Whereas today it's a narrow banking world where you're confined to using government debt credit. But in a free banking world, you can use whatever the hell you want to back your money, whatever lasts in the market lasts. And I think that's a world where we start to see Bitcoin truly play out. I think the next step in the evolution of adoption for Bitcoin is going to be more as a reserve asset for these types of liabilities that people are trading for payment that are more stable. And that's something that we wrote about a while ago in our banking report when we were talking about the future of what's going to be happening long term with stablecoins and Bitcoin adoption, whether they're a vehicle for that. Because they allow people to gradually move into their Bitcoin exposure, basically, by minimizing the volatility and having exposure to it through a reserve. And I think that is something conceptually what Michael Saylor is talking about with the stretch product. That's what these guys are doing. We're saying, let's get Bitcoin and let's pay somebody a rate of interest and let's eliminate the volatility. And right now they're competing doing that in brokerage accounts. And I kind of view it as like a prototype version of this. Like the true value here is using it for payments, because really they're just creating a better mutual fund is what they're doing through what Saylor's doing. Doing it through a stable coin is creating a truly better form of money for people today. And then eventually reserves start to become, Bitcoin becomes a very dominant position. And people say, well, I get way higher interest on this because it has, 20, 30% Bitcoin backing it. And then eventually people are like, why do I give so much of the return of Bitcoin to the stablecoin provider? Why don't I just own Bitcoin myself? And I think like that's the trajectory of how I see a lot of Bitcoin adoption happening. So today everybody's like, Michael Saylor's stretch product, it's creating so much demand for Bitcoin. Get ready for people using Bitcoin as a reserve in stablecoins over the next decade, and that's going to be a lot bigger than what Michael Saylor's doing.
If you're a financial professional working with Bitcoin, you know the pain of messy CSVs, broken cost basis, and accounting tools that were never built for this asset. Bitmint fixes that. Bitmint is the Bitcoin native accounting platform built for CPAs, bookkeepers, advisors, miners, and serious Bitcoin investors. You get clean Bitcoin bank statements, reliable cost basis tracking, full reporting, and fiat integration through Plaid. No crypto talk, no workarounds, just proper accounting for the hardest money on earth. Create a free account or book a demo at bitmint.co today.
Interesting.
Sorry, Wyatt. I'm getting a little bit of. Are you hearing that, Eric?
Yeah, it's really loud.
All right, I don't know. It got louder. We can cut that out. I just curious if everyone was hearing that. Okay, so Eric, I would be remiss if I do not ask you about AI, because it seems like in the Bitcoin world, right? Prices not doing what everyone hoped it might do, and there's a pivot on the mining side that I'm seeing where they're moving compute, a portion of compute over to AI, so that they can earn more per megawatt, right? But then even in the Bitcoin space, I'm sure you're seeing it. It's like, okay, well, how do we get the narrative? How do we get a narrative, right? Because it seems like people are. I don't know. I'm hearing that on the ground. I don't know if you're hearing that on the ground of like, do we have a strong narrative? But my question is, how do you see AI fitting into Bitcoin and helping to propel it? Because of course, I do think AI helps basically make companies more efficient and money movement. What we've been talking about, essentially reducing friction. And so I'm curious if you're seeing that in any of the portfolios. You talked about pivoting, companies having to pivot multiple times. Is that something you're seeing on the ground just broadly?
Yeah. Did you see that pivot from Allbirds? That's got to be an all-time pivot.
Right, exactly.
I did see that.
So no, but that's a good point, right? Like, so there's a lot of companies that there's people that are nominal AI companies. There's people that, and this is true of anything in any sort of company. If you're reasonably intelligent, if you're a pretty mid-curve CEO, then what you're doing is you're following the narrative trend. And there's people that, it's a full-time job, they make a good living doing that, and they just follow narratives and shift, and they don't really have a North Star, but it works. I think that there is, there's obviously just like the general trend of AI's impact on cost structures within companies. What we see today, boots on the ground, is founders who are like, we wanted to raise to hire a few more developers, and now we're just not. We don't need to do that now. So that's huge. Startup costs are dropping off a cliff, at least within software and more technical areas. And that's one of the things that I think we're monitoring most closely. There's no answers to this yet. We're all just witnessing it happen in real time. But the question is how does value shift when the cost structure shifts? What new markets does that enable to occur that couldn't have occurred before? And what is the new type of organizational structure? So, one of the trends of everybody saying like Bitcoin or AI is going to create the first like single person $1 billion type companies. And like, we certainly will see that. But it's a question of just like, what are the more valuable resources when a lot of other things get automated away? And it truly, I do believe in the idea. It's the era of the idea guy, and thank God, I needed that. And
we neaded our time.
I didn't have much left in me. I didn't have much left, and I think that with the like when you have this emerging, it's just like, okay, so like salespeople, person to person, all of these things become a lot more valuable. It's going to get a lot more competitive too, because there's going to be a bunch of people transitioning out of other roles. But those are the areas of like the structural shifts that I don't have a good answer on any of it yet. We're monitoring the situation. I think that as it relates to Bitcoin, we're working on a paper right now with some of the Harvard undergrad students on doing AI payments with Bitcoin, and we'll kind of see where that ends up. But that's one of the more interesting areas that I was skeptical. I think when this narrative first started emerging for a period of time, I think what changed my view of people saying AI will choose something like Bitcoin is once you realize it's kind of the wrong way of saying the right thing, I guess. The right thing is that credentialed payments are going to be very high friction in how this new economy works online that has AI. And we don't want to have payments that require credentials. The best form of doing that is going to be coming from, I think, a lot of open source technologies and how they're leveraging Bitcoin. Now, stablecoins can be used for that too. And every VC and their mother in Silicon Valley is they're touting that narrative because that's great for their bags. And it will be good for their bags. I think that once the realization occurs of like, well, we're kind of witnessing a Cambrian explosion of new innovation. It's going to be impossible to regulate. And there's going to be, I don't think it's going to come from people saying, oh, hey, Tether, blacklist these people or their agents that are using stablecoins for these things that we don't like. I don't think it comes from that as much as there's going to be so many new markets that are in a regulatory gray area that people don't know how to interpret. Like I could even see people saying, to be on the safe side of things, don't use stable coins because those could be blacklisted and those could be considered, an exchange of payment, whereas Bitcoin's itself is in a gray area as property. And it might make more sense to use something like Bitcoin just because everything's so gray. I think that's going to be one of the interesting areas that we see. But what we do know is that at least for like large volume settlement, it's very obvious that people don't want to use something that can get blacklisted and Bitcoin can't, at least not in a private form. And that'll be something that people ultimately gravitate towards. But I try not to like dilute ourselves in our thinking about Bitcoin's the next level of payments for AI completely. But we are kind of still manning that case right now. And stablecoins are going to have their day in the sun for a long period of time. But over the long term, Bitcoin will win out because it's better money.
Certainly is better money. A little bit out of left field here, but just kind of interesting trend that's been coming up in our last 3 to 4 episodes is this conversation on if Wall Street's actually come to Bitcoin yet. James Lavish wrote an interesting piece the other day about how most firms were just doing basis trade with Bitcoin and they're not here in a meaningful way. Just being broadly in the finance industry for a while, Eric, what do you think of this kind of question on if Wall Street's actually come to Bitcoin?
Yeah, I typically assess this like, I think if you try to assess it nominally, we're such a small percentage of capital, securities, etc. So like on a proportion basis, it has a long way to go. But if we look at it for in relation to its existence, it's historic in terms of its adoption. When we talk about it being like the best selling, I think it is the number one financial product at BlackRock now. Fastest growing ETF in history, like by far and away. So all of these characteristics are very strong leading indicators to say this is probably something that's eventually going to be, maybe the largest or best selling product on Wall Street. I think what's cool about it is it's something that doesn't need to have Wall Street productization to be used. And that's what changes everything about it. And that's what makes it attractive to people on Wall Street in the first place. And eventually people use it outside of that. But for now, it's, the scaffolding that gets people into the system. So I think that I agree with that. I think like anecdotally from evidence of whether it's people that we talk to as it relates to fundraising or just in general in lieu of whatever I'm doing on a day-to-day basis of networking, the people that I talk to in the traditional financial world, I think the biggest shift over the past year was people don't by default laugh at Bitcoin anymore. The people who don't know anything about it at all and are stupid for having an opinion on it in the first place because they don't understand it at all. Their default formerly was to laugh. It didn't have the social proof that these are just people who follow what their superiors tell them for themselves. And like, those are the people who laugh at it and say it's stupid or it's speculative or it's for criminals or something like that. And those types of people who still don't know anything about it are now shifting towards an open-minded perspective on it. Why? Because the people around them who actually do think for themselves are starting to have a differing opinion on it. So I think that shift has been more Bitcoin is digital gold. That's their view on it. I don't think, anybody in finance really sees the big vision with Bitcoin yet. But they see, digital gold is kind of like, it's like the digital gold is like when you're trying to get your dog to take its medication and you have to put the pill into something really sweet. Like that's what digital gold is for Wall Street. It's like helping them they don't know how good it is for them. And that's pretty much what we're doing with a lot of these different narratives. But anecdotally, that shift in like the zeitgeist of how people are viewing it, I do think that's huge, because it's a sign of the times. It's a sign that this asset's being taken seriously by people now. But I don't really care that much because, well, it's not true. I do care because I have to raise money from these people. But if I didn't, then I would say Bitcoin is going to win regardless of whether or not Wall Street understands digital gold. That obviously like increases the pace at which capital accumulation of it occurs. But one way or another, it's still going to grow whether or not they understand that.
I got one more question for you, Eric.
All right.
Do you know where the Bitcoin servers are?
The servers?
Yeah.
Satoshi servers?
No. Do you know where just the Bitcoin servers?
The Bitcoin servers, if there were Bitcoin servers, they would be in the basement of the space. I'll tell you that right now.
Did you see that guy that's been taken so seriously? Yeah. He was like, once they find the Bitcoin servers, dude, it's all over.
Oh, it's so funny.
I agree with him.
When I go when I go to these like RIA or family office events, and some dude like who has an opinion on Bitcoin, and then within like 5 minutes is kind of like, oh shit, I can't believe I had an opinion on Bitcoin.
This guy in a backwards hat coming to this conference is just intellectually dunking on me. I love it. I love that. That's a great place for us to end.
Yeah, good on you, brother. We're super appreciative of you coming on. Thank you for the insight, and we'll definitely have you back soon.
All right. Thanks, Eric.
Hey, we appreciate you joining us. If you want to help build a future of Bitcoin and financial services, make sure to hit that subscribe button, leave us a review. You can sign up for our newsletter, and you can share this content with someone in your network who is integrating Bitcoin into their practice. The more professionals we reach, the better served our clients are. Stay sharp, stay sovereign, and keep leading from the front.